This is the Energy Makers Show, featuring the innovators, financiers, and policymakers focused on the global energy demand. Brought to you by NRG, moving clean energy forward. And here's your host, Paul Dickerson.
Hi, I'm Paul Dickerson, and welcome to another episode of the Energy Makers Show. First up, Deborah Byers, managing partner of the M&A practice at Ernst & Young, talking about energy, tax, politics, and the abundance of domestic natural gas. Next up, Kevin Conlin, CEO of Sunstop, a 25-year solar veteran who started providing solar in the oil and gas industry, now talking about his new electric vehicle charging stations. All that right after this.
This is the Energy Makers Show, brought to you by NRG, moving clean energy forward. And now, back to the Energy Makers Show with your host, Paul Dickerson.
Welcome to the Energy Makers Show. Our guest today, Deborah Byers, managing partner at the M&A practice with Ernst & Young. Deborah, great to have you on the program.
Glad to be here, Paul.
So tell us a little bit about your practice.
We are, of course, Ernst & Young. We provide the normal services that you would expect, audit and tax services, but I head up our M&A practice. And here in Houston, we've got about 70 professionals focused on oil and gas. So we have lived the M&A trends and everything that's been happening with the gas shale revolution. But we've had an interesting ride even through the downturn.
Well, and there's been a lot going on. Let's start with taxes. Tell me, we're in an election year. I know President Obama has been proposing all sorts of taxes or taking away of certain incentives for the oil and gas industry. Can you lay out for our viewers the current state of things and what you see coming?
Sure. I mean, as you say, election year and quarterly profits coming out, high fuel prices. It's really put a big spotlight on these provisions. They've been in the budget since 2011. And they would be things like repeal of the current expensive intangible drilling costs, repeal of percentage depletion. These are things that kind of interestingly, even though they're linked, in discussions to the bigger operating oil and gas companies, they really are, they're really more suited for the smaller operators, the independents.
Tell me more about that.
Well, intangible drilling costs, as you know, in oil and gas, there's a long lead time. You have to spend a lot of money before you get your first drop of production. And so the intangible drilling costs are monies that the company spends up front, and it might be 3 months, it might be a year before they get $1 of revenue.
Right.
So it's natural that they would get a deduction. Currently. Makes sense. And so what they're talking about is really repealing that current deduction. And a lot of these smaller independents, they don't have that kind of cash flow to carry them forward to continue the drilling program, which is so important to keep up our production and to increase the production. These are all things we want to do: energy independence and increasing our supply and keeping prices low. You take that away, it really will limit their capital budget. And it also increases their cost of capital. It disproportionately impacts what I'll call the entrepreneurs that are on the ground that need these types of current expenses.
It's amazing how these unintended consequences, focusing on the big guys, but even the majors, the margins aren't that great.
That's right. I mean, a lot of people focus on the big headline number. And I think they suffer from the fact that in order to engage in these big capital programs where you're having to spend billions of dollars up front, you have to be big.
Sure.
So when they start producing, the numbers are big. And instead of focusing on that top line, people need to look at, well, what is the net take per dollar?
Right.
What is their profit per dollar that they spend? And if you compare them within the industry, they're always consistently in the bottom third. So as opposed to, say, pharmaceuticals or financial sector who have a higher margin because they don't have as much capital tied up in order to produce that dollar of revenue.
So what should we expect as we work through this election year?
I wish I had an answer to that. As you know, nothing really significant is going to get done. Congress is talking now, and I can't guarantee anything. Most people think nothing's going to get done until the lame duck. Now, if you're familiar with the way tax policy and legislation happens, there are some provisions, for example, the Bush tax cuts, that will expire.
Right.
There are some provisions that we just can't allow to expire. Things like R&D credits, those are things that we need to continue to have. And so some action has to be taken to extend some of these expiring provisions.
Well, let's switch gears and talk trends. Tell me some of the trends that you're seeing in the oil and gas industry.
Well, I know everybody's seen it, the shale revolution.
Sure.
And, and one comment that I want to make on that to keep in mind as we talk about this is the U.S. is not the only country that has this resource. In fact, there's probably arguably greater shale resources in China, Argentina, the Middle East, believe it or not. But the U.S., because of our unique entrepreneurial spirit and our ability to really move the market and capitalize on opportunities, we're able to develop our resource that much quicker.
Right.
So 5 years ago, you weren't talking about natural gas prices at the prices that they are,
right,
or the supply that we have,
sure,
and potentially 200 years of really natural gas that we would have. It has been amazing because and the volume of transactional activity is very high because you have smaller independents who really drove that revolution.
So as you were saying earlier about the politics of these tax adjustments, this really affects it.
Oh, absolutely. I mean, I think that because of the direct impact to the cost of capital, it could have potentially slowed down what was a tremendous development in the shale market.
Absolutely.
But there are a lot of small players, landmen out there, looking at these assets and then rolling them up and bringing them to production. So the need for capital for these smaller players is huge. Yeah. So you've seen a lot of foreign investors from Asia, India, just the capital that's coming into the U.S. to take advantage of this investment opportunity for them also to learn the technology so that they can take it back to their home country. As well as big, transactions like Exxon buying XTO. I mean, that's
right.
XTO being a very strong player in the shale space early on.
Well, and there's talk with all this supply about should we export, should we keep the gas at home? Can you tell our viewers a little bit about that?
I think it's a again, 5 years ago we had Cheniere and Freeport. They were receiving terminals for
right.
LNG that was going to be coming to the U.S. from the Middle East. And now we're going to turn that around.
Yeah. And
there is a big race to convert those so that we can export LNG from the U.S. because we have an abundance of dry gas. Of course, there's other sectors that will benefit from the gas supply, and that's going to be the chemical sectors, utilities, gas-powered right. plants. Suddenly they're looking at long-term gas supplies that could be, very, very economic and powerful as a boost to the utility sector. So there are so many forces at work, and there is a major paradigm shift because, we were thinking we're in a decline of production.
Absolutely.
And all of a sudden, not only is there an abundance of dry gas, but as you know, there is a ton of associated liquids, and now what we call the oily shale.
Right.
And that's where all the production and all the activity is right now. And so that's actually increased our crude production. And so we've turned that around as well. And that's a key factor in getting to real energy independence on our transportation fuels.
Well, tell me a little more on within the chemicals industry and they're benefiting from that cheap natural gas. How do you see that playing out?
Well, I mean, it's hard to say yet because I think it's early stages. I mean, there are companies looking at making some big bets, both U.S. and non-U.S., suddenly saying, well, instead of, building these facilities outside the U.S., and then exporting product out, maybe they could build them here in the U.S., take advantage of, long-term supply contracts for gas, and then there's also a ready market for those products here in the U.S. So it's really tremendous. There's a lot of projects on the drawing board. What will get done? It's hard to say because the market will find an efficient outlet for all of that production.
Well, very informative. Thank you so much for coming by today.
It was a pleasure to be here.
And that concludes our discussion with Deborah Byers. We'll be back with more right after this.
Where will the energy come from to move us forward? From natural sources in abundant supply, or perhaps a man-made source? At NRG, we believe innovation will solve our energy needs. That's why NRG is moving away from fossil fuels towards wind, solar, and other sustainable technologies to power the smart grid, the electric car, and our clean energy future. We're using all of our energy to develop more of it.
This is the Energy Makers Show, brought to you by NRG, moving clean energy forward. And now back to the Energy Makers Show with your host, Paul Dickerson.
Welcome back to the Energy Makers Show. My guest now is Kevin Conlin, President and CEO of SunStop. Kevin, great to have you on the program.
Paul, thanks so much for having me.
So tell us about SunStop.
Well, SunStop is a solar-powered charging station concept, and we're trying to promote the idea of charging electric vehicles with solar energy. It makes a lot of sense. It provides shade, and our SunStop stations can do a lot more than simply charge an electric vehicle.
We have this state in America where we don't quite have all the electric vehicles yet we need the infrastructure. And the chicken and the egg, which comes first? I thought you worked around that challenge in some innovative ways.
We think we did. What we did was we've designed our stations to not rely on EV charging revenues. And as you mentioned, it's probably going to be a decade before we can really count on those revenues consistently. So we've designed our stations to perform a multitude of other functions on a daily basis that do make sense and generate positive cash flow.
Tell me about some.
For example, we can power vending machines. We can power ice machines, pure water machines. Machines that, in the event of a natural disaster or a hurricane, would be a community asset because they can continue to operate, they can continue to dispense clean water and fresh ice throughout the duration of the hurricane. So it kind of becomes a community service under an emergency situation.
So are these things mobile?
Not really. They've got a fairly large battery bank in them, and we prefer to find a stationary location. Ideally, it's a location where people have 6 or 8 hours to charge their car. Maybe they go to work or spend some time there. Because it's solar, we like to slowly charge the cars. It's a little more efficient than the fast charge, but we can do that if necessary.
All right, so what's the growth plan for the company?
That's a very good question, and it's very hard to predict right now. The market is changing very quickly. The solar market is changing quickly, and the EV market is proving to be a little bit more of a slower rollout than most people would like. So now, Paul, we're looking for other applications on military bases, for example, where the Department of Energy has taken the initiative to conserve liquid fuels and adopt renewables. We think military bases are going to be our next key target market.
Well, certainly the Department of Defense has stepped up in some big ways trying to deploy some of these renewable energies on site.
Yes, they have, and it's a combination of large arrays for bulk power generation. Now, we also think that as they convert their fleets to electric vehicles, having solar charging stations throughout the base makes a lot of sense because, again, the electricity is basically for free. We have backup power, so if the base loses power, we can continue to provide critical services. And a military base is kind of a perfect site for an electric vehicle. You don't go far, you never go fast.
Right.
And because they own the vehicles, if there's an incident, they can call them back to the charging stations, and by simply plugging into the station, we can now draw electricity off the vehicle as well. And then when you look at the long term, when you look at the vehicles don't have any liquid fuels, they don't need oil changes, transmission changes, or anything like that, the cost to service and maintain these vehicles goes down considerably too. So you have a lower operating cost, a lower fuel cost, and an extended vehicle life. That makes a lot of sense.
You mentioned storage earlier. How has the state of storage technology affected your company?
It really hasn't. Because of my background in high reliability systems for the oil and gas industry, I'm very familiar with batteries. I'm not intimidated by them. I understand how they work. So for our storage, Paul, we're simply using big, bulky lead-acid batteries. The weight isn't an issue. They're predictable. We've been using them for 100 years. We know what to expect. They're reliable. And for this application, they're the perfect battery. So we're not really needing any new technologies to move this idea forward.
So when you transitioned to the oil and gas space, were you still working with solar?
Yes, I was. I was developing new products usually for remote pipeline stations and offshore platforms. It's kind of interesting. Most people in Houston wouldn't realize the solar development that's gone on in conjunction with the oil and gas industry over the last couple decades. And the oil and gas industry has actually promoted and pushed this industry forward. In the mid-'70s, for example, a company called Tideland Signal here in Houston started using reject solar cells from space satellites and started putting solar-powered nav aids on offshore platforms. No one had ever done that before, but it's an industry standard worldwide now. There were companies that built the first packaged systems, skid-mounted systems. The first use of solar in the geophysical industry occurred here in Houston. And there's been a long string of slow progress, primarily due to gas pipeline companies and offshore oil companies simply needing an alternate source of energy.
Absolutely. That remote power on site where it's just not economic to string the power line all the way out there.
Exactly. Most people are kind of surprised to find that one of the biggest users and customers of solar is oil and gas.
Now, you mentioned focusing on Houston, but I know that you have plans around the world,
Yes, sir.
in Africa and elsewhere. Tell us about it.
Yes. One of the things that's important to our financial model is to find places where there's aggressive incentives in place. In Texas, if it's a solar station, there's only a 30% federal tax credit and then a small tax credit for the electric vehicle infrastructure. But in other states and with other utilities, the incentives are a lot more aggressive. They're pushing the adoption a lot faster, and in those cases, we might get 50 cents back on the dollar. That's the low-hanging fruit we're going to go after first.
Well, Kevin, thank you so much for coming in, and congratulations on your success.
It's been a pleasure, Paul. Thank you.
And that wraps this episode of the Energy Makers Show, heard on the radio nationwide and seen right here at TheEnergyMakers.com. I'm Paul Dickerson, and we'll see you next week.